back, ladies and gentlemen, to the Real Men of Real Estate. I'm your host, Thomas Chappell. We're sitting here talking to our guest, Mikhail. And Michael, I had asked a question before we went to commercial break. What did you think about people that comes to these investment clubs? Because it's going to tie into my next question. So if you can elaborate on that real quick before I go into my next question, I really appreciate it.
Well, I mean, I've never gone to the investment club, so I'm not really sure which ones you're talking about. I mean, I know about them. I've heard about them. I've heard of some people literally spending $50,000 to go
Yes.
to some of these clubs.
Yes.
You want my real opinion?
Go for
It's bullshit.
it. Okay.
A lot of them, about not all of them. Some of them are good that help people, but if you're paying $50,000 to go learn, listen, the best way to learn something is to do it, right? Like you said, get a JV partner, get into it, get your feet wet, get into it. If you're paying $50,000 to learn, I mean, I bought my first house in 19. I didn't pay $50,000 to learn real estate. It's the same thing I say like about all these, online gurus on social media. If they were so good at what they're doing, they wouldn't be charging people for their get rich quick scheme.
Exactly.
So they would be too busy making money doing what they're doing rather than trying to charge people $150 to buy their whatever.
Yeah.
So yeah, no, I don't believe in it.
So with my club is basically I don't charge anybody because same way I felt, when I got started, my mentors took me up under their wing and taught me this business, and by me showing up every day and being active, I was able to learn and get to where I am. So going into my next question here is what's the great way to build a profile doing rental loans?
You mean as an investor to build a portfolio?
Correct.
I mean, again, I see things very differently than most people, right? I mean, we get people all the time that obviously apply, and I actually did an article about this in an interview not too long ago about being a better borrower. People, you see people like a 400 credit score and no money in the bank, but they're trying to be real estate investors. No, go back, take a step, fix your credit, become a better borrower, right? It's significantly easier to secure financing and to get more successful and get further. You got to realize when I bought my house, I'm 41 next month. I bought that house in, I don't know, 99 or 2000. It was before you had what's called institutional financing, right? Hard money, which is a term we'll talk about, private money, whatever you want to call it. By the way, rental programs are not hard money loans. Let's get this clear. Hard money loans are only bridge loans. There was no institutional financing. So the way you did a deal, 20, 25 years ago was that you found some old rich dude who had money and you had to meet him somehow, and they would just lend on property. So there was no, really underwriting, getting full appraisal and documentation, but that's why the rates were 24%, because, you got to realize how rates work. Besides the secondary market and besides the LIBOR and all these other factors which control interest rates are controlled on underwriting. The more underwriting there is in a loan, the safer and more secure that paper is, that loan is, and then the lower the rates are going to go. The less underwriting a loan has, the higher the rates are going to go. So when you're going to some person who's just giving you money, there's very little of any underwriting, so obviously the rates are going to be significantly higher. Rental programs, which are term loans, right? Term loans, 5/1 ARM, 30-year fix, whatever the case may be. If you want to, is to be a better borrower. Term loans require higher credit scores. You're going to put your down payment down. But again, like my tactic to real estate is very different. I don't care about rental income. I care about chunks of equity. So, I bought a significant amount of property, which I'm not buying anything right now because I think the market's too high. But when I do buy, I buy significantly under market value. I just know how to find them. And then I buy for chunks of equity. So meaning if I'm buying something for, let's just call it, $170,000, the day I buy it, I want that appraisal to read, obviously a legitimate appraisal. I want it to read 300, right? Because I'm buying chunks of equity. That's just always been my tactic. I never cared about rental income. I cared about chunks of equity.
Okay. Okay. Now, what's you got hard money loans versus fix and flip loans? What's the difference?
Yeah, so I wrote that article for the Scotsman Guide a couple years ago. So a true hard money loan, which everybody, even people in the industry, they all mess it up, is an asset-based loan, which is not necessarily looking at the borrower, right? We have those programs that people don't understand. They max at like 50, 55, 60, 60 is even going high. Call it 55, 60 LTVs where they max. So when somebody comes to you and they say, hey, I want a rental hard money program that doesn't exist, or I want a 90 LTV, right? So normally there's ratios on a fix and flip, right? 90, 100, 75. So 90% of the first lien, right? So the first lien is 90%. So you're putting down 10%, 100% of the rehab, and then 75 of the ARV. We actually go high at 75 ARV. Some companies are 60, 65 ARVs, I'm sure you know. So if you're talking about a loan that has underwriting or significant underwriting and is basing a lot of underwriting on the borrower, like a fix and flip loan, and is not truly an asset-based loan, then it's not a hard money loan. Also, a rental program is not a hard money loan, right? It's a 30-year or 5/1 ARM. You're talking about rates, 4 or 5%. Clearly not a hard money loan. A hard money loan is only, 3 to 12 months, could be longer, could be 24 months. It's always going to be a bridge loan, and it's going to be a low LTV. Call it 60 LTV max. Sometimes you might find it a little higher, but nothing, 80, 85, 90 LTV. In order to get to 90 LTV, you have to go through a decent amount of underwriting on both the property, the location, the borrower, your assets, your credit, et cetera, et cetera, et cetera, which defines what a hard money loan is. The loan that I got in 1999 or 2000 or whatever it was, that was a true hard money loan. I was 19 years old. I met this guy in Florida, and he lent me money to buy a property. Didn't look at a damn thing that I had, nor did I have anything. But the property had a significant amount of equity in it, right? Which is an asset-based loan. They were basing the loan based on the amount of equity in the property, because you got to understand how this works. And I realized how many people don't know how this works. When anybody lends to you, whether it's the guy down the street or an institutional lender or a major bank, and people don't want to hear this, but the first thing they think of is how can we foreclose, right? Because if you're going to lend somebody money and they don't pay, then you have to foreclose to get your money back,
Yes,
right?
sir.
That's why we get people that ask us, "Oh, do you lend in Mexico? Do you lend in Puerto Rico?" No, because you can't foreclose in these other countries, or it'll be almost impossible. So when somebody gives you a true hard money loan, like this guy did, if I messed up, he's getting the property. I'm going to default, and he's going to take a property back with tons of equity. Unfortunately, there are a lot of companies, I'm not going to name names, that literally do that, and a lot of investors who've been investing will know what I'm talking about. Of companies that lend people money, hoping that they actually mess up because these investors are finding good deals, or at least they used to before the market skyrocketed. And then when people default, it's an investment property, right? So it's not an owner occupied property. Depending on your state, you can foreclose relatively quickly on an investment property and the commercial property, because it's not owner occupied, you're not living in it. So, it's not mandatory to have an investment property, so you can foreclose fast, but that's how it works. They think of how can we foreclose and how fast can we foreclose? And that was a big reason to the crash we had and the problems we had in 2008, 9, and 10, because the market crashed. People weren't paying for their mortgages. And then I personally know people, I'm sure you do too, that lived in a home for 10 years and didn't pay a mortgage. What people don't understand is that money. So let's say you're a lender and you have $1 billion line of credit, because this is how this works on lines. And you lent out $500 million. And all of that is foreclosed upon. And you can't foreclose on that property to get that money back. You're gone. Your company's bankrupt and you're belly up, because you can't replenish that money. So one of the reasons why we even have the kind of private money, et cetera, kind of financing that we do these days is because they're on investment and commercial properties. If somebody if somebody doesn't make their payments on an investment property, and you got to realize that rates and guidelines are different depending on what state you're in. States that you can foreclose faster literally have lower rates than states that you can't foreclose as fast. It could be by 1 or 2 points or 1 or 2% in that state, because the lender has to make up the difference on ratios of all these other properties that, God forbid, they have to foreclose on, that it might take them an extra 6 months to a year to get their money back. So they across the board have higher rates in those states to offset, their foreclosure rates.
So if I came to you and says I'm brand new off the boat and I'm not sure exactly what it is that I'm doing, would I be considered a good candidate, or would you say, well, you know what, you need to do this, and then come back to me?
Well, I mean, again, I haven't done a loan in years. I have a full sales team that does it all. But I mean, again, if somebody qualifies, they qualify. It doesn't matter who, what, when, or how. They qualify, they qualify. Generally, the issue is, like I said, is generally people that are new don't understand what it takes and the amount of money they need. Like, you'll get people every day like, I have $10,000 and I want to buy a $400,000 house. Well, that's not going to happen. So you have to. They don't realize where they need money and how much money is needed. Like, a lot of people come to the investment world and they see the advertisements for FHA loans. 3.5% down, whatever. Obviously, that doesn't correlate into the investment world. We have the highest LTVs that I know of. Generally speaking, I'm sure your listeners can agree. If you go out to the market and you're trying to find a term loan, which is a rental property loan, on a purchase, you're generally maxing at about 75 LTV. We have programs on a term rental loan at 85 LTV. Used to be 80. Recently, we picked it up to 85, but very high credit scores, over 740 for that. But yeah, they generally don't understand where they need money and how much money they need.
Okay, we get ready to take our final break. We're gonna come back and wrap it up with our guest here. So appreciate you. Stay tuned.